Cash flow is the lifeblood of any company. Seasoned business owners are well aware that while turnover and profits matter a great deal in the long run, it is cash flow that will quickly make or break the company. That is why small and medium-sized enterprise financing is an evergreen concern for all small businesses. With less bargaining power due to the smaller size, SME owners often have to pay first for products or services from suppliers, and are usually last when it comes to payments by customers. This gap in payments in certain industries can be up to several months, such as in the construction sector. When unexpected crises hit, such as late payments by customers or budget overruns, businesses without adequate financing can be left high and dry. With so much at stake, SMEs need to ask themselves, are my current financing facilities adequate for my business needs and future expansion? Having said so, startups with less than 3 years of operations are often not within the bank's risk appetite. As such, those younger SMEs will have to go to higher risk appetite non-bank financial institutions and pay a high interest rate that eats into their cash flow. Even SMEs that are more than 3 years old still need to maintain a good set of financials before the banks will provide reasonably priced unsecured loans to them. With a number of government-assisted financing schemes in Singapore, they serve to alleviate some financing difficulties for SMEs. Some examples of local enterprise finance scheme (LEFS) are SME Equipment Loan. SME Equipment Loan supports equipment financing for companies with higher risk profiles. SME Micro Loan. SME Micro Loan provides working capital financing for micro enterprises. SME Enhanced Micro Loan for young micro enterprises less than 3 years old. They can leverage on SME Enhanced Micro Loan for low-cost working capital financing. Banks are still the most popular option for SMEs because banks are able to provide the cheapest interest rate to the SMEs who are eligible to borrow from them. Many banks in Singapore have an SME presence, making the space an extremely competitive one. Different banks have differing credit criteria and loan conditions. So it pays for SMEs to shop around to find one that can best meet their needs. Aside from banks, financial institutions are the next port of call for SMEs looking for loans. SME owners now are able to approach licensed finance firms such as Hong Leong Finance, Sing Investments and Finance and Singapura Finance for uncollateralized loans such as the SME Micro Loan. Another avenue where SMEs can get their business financing is via peer-to-peer (P2P) lending. Though still in its nascent stage, P2P lending is getting noticed by more SMEs due to the spotlight on fintech. As the name suggests, P2P lending pulls together funds from investors. Crowdfunding platforms directly connect lenders to borrowers, disrupting the bank's traditional dominance in the SME financing scene. While the P2P lending options are dazzling, crowdfunding platforms tend to have higher interest rate loans. So it is not a good long-term and sustainable financing option. Need more information on the important items to keep in mind to ensure the successful approval of your SME micro loan? Visit growingoverload.wordpress.com.